Hello everyone, this is Ritika Ambast, Assistant Professor at IIMT College of Management, Greater Noida. Today's my topic is accounting concepts and convention. Let's begin with topic. First we will discuss accounting concepts. What is accounting concepts? Let's see. Accounting concepts are those basic assumptions and conditions which form the basis upon which the accountancy has been laid. It means we can say concept is nothing, it's only assumptions and conditions on which accountancy has been laid. Accounting concepts define the assumptions on the basis of which financial statements of a business entity are prepared. So, we can say some assumptions or conditions by which financial statement of a business entity are prepared. There are many concepts which are as follows: business entity concepts, money measurement concept, going concern concept, accounting period concept, dual aspect concept, matching concept, realization concept, and accrual concept. We will discuss it one by one. First concept is business entity concept. What is business entity concept? This concept says or assumes for accounting purpose, the business enterprise and its owner are two separate independent entities. What? Two separate independent entities. Thus, a business and personal transaction of its owner are separate from each other. We can't take as owner's expenses treated as same as expenses of its business. Similarly, for example, when the owner invests money in the business, we consider it as a capital. And what is capital? We are treating capital as a liability. Why? Only because we consider business entity and owner are separate from each other. Similarly, if we take another example, when the owner takes away from the business cash or a business goods for his personal use, it is not treated as business expense. We are considering it as drawings. We use the word drawing if owner takes away a business goods or cash for personal use. We are treated as drawing. So we can say business entity and entity identity of its owner are separate from each other. They are not similar or same. Next concept is money measurement concept. It is the most important concept. By why? Because it gives us a basis for recording transactions of a business. So what is money measurement concept? This concept assumes that all business transaction must be in terms of money. What it says? All the business transaction must be in terms of money. That is in the currency of a country. In our country, India, such transactions are in terms of rupee. We are recorded in rupee. Thus, as per the money measurement concept. Why? As per money measurement concept, and transaction which can be expressed in terms of money are recorded in the books of accounts. Which kind of transaction we can record? Which we can expressed in money terms. For example, loyalty are not recorded in the books of account because these can't be measured in the terms of money, although they do affect the profit and losses of the business concern. If employee or management of any organization are loyal, they must uh, impact on the profit of the business, but we can't measure in terms of money, so we can't record it in the books of account. We can take another example. Mr. X and Mr. Y had argument in company. Both are the departmental supervisor or a departmental manager and had argument in a company. Can we record this? Of course no. If departmental supervisor had argument, it may lead to loss of in the organization, but we can't record this. Why? Because of we can't convert it in money terms, we can't express it in money terms. Let's take another example. IIMT College of Management purchased 4 chairs and 2 tables for faculties. Can we record this transaction? No. Why? Because I did not mention here any currency, any money terms transaction. I say 4 chairs and 2 tables. I am saying in numbers of furniture. I'm not saying in money terms. Like if I say IIMT College of Management purchased 4 chairs and 2 tables for faculties for 50,000 rupees, then we can record or maintain recording for furniture account, like 4 chairs and 2 tables for 50,000 rupees. But here we are mentioned 4 chairs and 2 tables. So we can't record in books of accounts of IIMT College of Management. Okay. Next concept is going concern concept. What is going concern concept? This concept says that a business firm will continue to carry on its activities for an indefinite period of time. Simply stated, it means that every business entity has continuity of life. Thus, it will not be dissolved in the near future. We assume that our business will not dissolve in near future. If we will not do the same, we can't we will don't well, actually it provides a basis for showing the value of asset. If we'll do not the same thing, we will not have basis for accounting. Why we are maintaining accounting if we know our business will dissolve in near future? So this concept give us basis for showing the value of asset in balance sheet. Accounting period concept. What is accounting period concept? As its name says, period, accounting period. All the transactions are recorded in the books of accounts on the assumptions that profits on these transactions are to be ascertained for a specified period. This is known as accounting period concept. Thus, this concept required that a balance sheet and profit and loss account should be prepared at regular intervals. This is necessary for different purposes like calculation of a profit, ascertaining financial position, tax computation, etc. Actually, this concept says we should divide our life of company in a smaller period. Usually we take 1 year. And why why we are dividing period in a year or in a small part, so that we can calculate profit or ascertaining financial position or tax computation. There are many uses of books of balance sheet and profit and loss account, trading account. We are maintaining financial statement for this, for calculation of a profit, so that we can use it on further use for making strategy, for making for management use, for its investors use. So we should divide our life of organization in a smaller period. And next concept is accounting cost concept. It states that all assets are recorded in the books of accounts at their purchase price, which include cost of acquisition, transportation, and installation, and not at its market price. It means that fixed assets like building, plant and machinery, furniture, etc. are recorded in the books of accounts at a price paid for them. Actually, it says all assets are recorded in the books of account at their purchase price. For example, if we purchase AC for office use and for 50,000 rupees, and we spend 500 for installation and 500 for transportation cost, then if we can't record it, we should not record it in 50,000 rupees. We will record it for 50,000 rupees for AC plus 500 for installation and 500 for transportation, equal to 51,000. Not for market price or price paid for them. We will include its installation charges and every charges we have paid for them. Dual aspect concept. Next topic is a dual aspect concept. As its name says, dual. What do you mean by dual? Dual means two aspect. Which transaction? Those transaction which has dual impact on dual impact. Dual aspect is the foundation or basic principle of accounting. It provides the very basis of recording business transaction in the books of accounts. This concept assumes that every transaction has a dual effect. For example, it affects two accounts in their respective opposite sides. For example, if we purchase furniture for IIMT College of Management, it will impact both two accounts at the same time. If we purchase for cash 50,000 rupees, so AC account will be affected and cash account will be affected. Thus, the duality concept is commonly expressed in terms of fundamental accounting equation, that is assets equal to liabilities plus capital. Next concept is matching concept. The matching concept states that the revenue and the expenses incurred to earn the revenues must belong to the same accounting period. So once the revenue is realized, the next step is to allocate it to the relevant accounting period. This can be done with the help of accrual concept. If the revenue is more than the expenses, it is called profit. If the expenses are more than revenue, it is called loss. This is what exactly has been done by applying the matching concepts. It has two significance. It guides how the expenses should be matched with the revenue for determining exact profit or loss for a particular period. It is, and second significance is, it is very helpful for the investors, shareholder, to know the exact amount of profit or loss of the business, which is the main aim for the maintaining all the transactions, all maintaining and recording all the transactions. Next concept is realization concept. As its name says, realization. This concept states that revenue from any business transaction should be included in the accounting records only when it is realized. When it is realized, the term realization means creation of legal right to receive money. Selling good is realization, receiving order is not. If we receive order or if we order goods or anything else, it we can't say it is realized until when it convert into selling or purchasing. In other words, it can say that revenue is said to have been realized when cash has been received or right to receive cash on the sale of goods or services or both has been created. The concept of realization states that revenue is realized at the time when goods or services are actually delivered. The meaning of accrual is something. Next concept is accrual concept. The meaning of accrual is something that becomes due, especially an amount of money that is yet to be paid or received at the end of the accounting period. It means that revenues are recognized when they become receivable, though cash is received or not received, and the expenses are recognized when they become payable, though cash is paid or not paid. Both transactions will be recorded in the accounting period to which they relate. Our next topic is accounting convention. We have discussed all the accounting concept, and next we will discuss accounting convention. There are, first we should know what is convention. An accounting convention refers to common practices which are universally followed in recording and presenting accounting information of the business entity. Conventions denote custom or tradition or usage which are in use since long. To be clear, these are nothing but unwritten laws. The accountant have to adopt the usage or custom which are used as a guide in the preparation of accounting reports and statement. These conventions are also known as doctrine. Convention is nothing, it is a suggestion or a guide. We can say it is unwritten law. It's the only guide for usage of recording of accounting transactions. There are 4 conventions which are as follows: conservatism, full disclosure, consistency, and materiality. We will discuss it one by one. Let's discuss. First, convention of consistency. The convention of consistency means that same accounting principles should be used for preparing financial statement year after year. A meaningful conclusion can be drawn from financial statement of the same enterprise when there is a comparison between them over a period of time. This convention suggests us to use single method for recording the transactions so that we can compare year by year, year after year, the result of financial statement. But this can be possible only when accounting policies and practices followed by enterprise are uniform and consistent over a period of a time. If different accounting procedures and practices are used for preparing financial statement of a different years, then the result will be not comparable. If we use a different method in different years, we will not able to compare the result which is profit or loss. We can't compare. So it needs consistency. It needs consistent method of recording. Next convention is conservatism. As its name shows, anything is conserved. This convention is based on the principle that anticipate no profit, but provide all for all possible losses. It says don't show anticipated profit, but yes, you should disclose your possible losses. It provide why? Because it provide guidance for recording transactions in the books of account. It is based on the policy of the paying safe in regard to showing profit. Its main objective of the convention is to show minimum profit. Profit should not be overstated. If profit shows more than actual, if profit shows more than actual, it may lead to distribution of dividend out of capital. This is not a fair policy, and it will lead to the reduction in the capital of the enterprise. Thus, this convention clearly states that profit should be recorded until it is realized. But if business anticipate any loss in near future, provision should be made in the books of account for the same. For example, valuing closing stock at a cost of market price, whichever is lower, creating provision for doubtful debt, discount on debtors, writing off intangible assets like the goodwill, patent, etc. The convention of conservatism is a very useful tool in situation of uncertainty and doubts. So we should not show anticipated profit, but yes, we should disclose all the possible losses. And next convention is convention of materiality. The convention of materiality state that to make financial statement meaningful, only material fact, important and relevant information should be supplied to the users. Accounting information. The question that arises here is what is a material fact? The materiality of a fact depends on its nature and the amount involved. Material fact means the information which will influence the decision of its user. So this convention says show only important and relevant information to its user. And next convention is a convention of full disclosure. As its name says, full disclose. Full disclosure principle refers to the concept that suggests that a business should report all the necessary information in their financial statement so that the users who are able to read the financial information are in a better position to make important decisions. Full disclosure is especially beneficial for creditors and investors. The disclosing of financial information helps in decision making. The information is readily available to investors and creditors in the financial statement or as a note in the end of the financial statement. As this convention says, don't hide anything to its users. It says disclose everything which is happen in an organization. Now you can see the convention of materiality and convention of full disclosure, it contradict each other. As materiality convention says, don't show don't show everything, show only thing which is meaningful and relevant. Don't show everything to its user. But at the same time, convention of full disclosure says don't hide anything, show everything, so disclose everything which is happening in organization. Both conventions contradict each other. One says don't hide and one says don't disclose everything. Hopefully this session will be helpful for you. Thank you so much for watching.